TietoEvry, one of the largest IT services providers in Scandinavia, has been a nightmare for shareholders in recent years. Despite strong headwinds, the company has continued to raise its dividend on a regular basis. Combined with the steep drop in the share price, this has pushed the dividend yield to an unusually high level of more than 9%. In this video, we'll show you whether that payout is sustainable or if investors should prepare for possible cuts. After years of stagnation, the company agreed to merge with rival Evry in 2019, but instead of delivering the promised growth, the mega merger remains unresolved to this day. The share price has reflected that disappointment, showing a persistently weak performance. TietoEvry is trying to reboot its growth story. For more than a decade, the Finnish IT services firm has been stuck in neutral. Organic sales growth has hovered near zero, while the broader market expanded by 4 to 7% annually. With newly appointed CEO Endre Rangnes at the helm, the company is betting on a leaner cost structure and sharper customer focus to spark a turnaround. The headwinds are clear. In the first half of 2025, organic growth fell 4%. An €80 million write-down in the banking unit added to the pain. Cash flow held by and large steady, but profitability has been under pressure from weak demand and intense price competition. Still, there are reasons for cautious optimism. TietoEvry's order backlog hit record levels in banking, up 14% overall. Its healthcare software unit Care is beginning to expand internationally, including a deal with University Hospital Basel. And client demand for projects that incorporate artificial intelligence is on the rise. To shore up margins and free up capital for investment, Rangnes rolled out an aggressive cost-cutting plan. By 2026, the company aims to trim $115 million in expenses, including more than 1,000 job cuts. Management says the second half of the year should look better. Order books in banking, care, and industry are full, and initial savings are already showing up in the numbers. Dividends remain a key test for investors. In the earnings call on July 22nd, CFO Tommi Hyryläinen confirmed it is sticking with its current policy, though executives signaled they will also need to plow more money into growth areas like banking software and AI. That sets up a delicate balancing act between rewarding shareholders and funding the future. The outlook is mixed. Years of stagnation weigh heavily on confidence, but the building blocks for a modest recovery are in place. On September 15th, the company trimmed its full-year outlook once again, citing an additional hit tied to a recent divestment. Analysts see roughly a 60% chance that Tieto will return to growth over the next 2 to 3 years, driven by the division's banking and care, plus cost discipline, while the Create division remains a drag. If the turnaround works, shareholders stand to collect hefty dividend payouts and enjoy meaningful stock gains. The opportunity is still there, but so are the risks. For now, this is a stock best suited for investors willing to take on higher risk.